Assalamualaikum and hi to our lecturers Muradin and fellow classmates. We are from Group 1, which consists of Amir Huzairi bin Khairul Faizi, Muhammad Zuhairizan bin Suhaimi, Siti Nurain binti Binbun, Lee Kesing, and myself Norazlin binti Ijim. Will be presenting on the SME issues and selected investment appraisal question, which is the sweet candy berhad. Our slide will contain on the definition of investment appraisal, project benefits and costs, relevant cash flow, selected decision-making techniques for the project, advice on the action to be taken using the selected decision-making technique, and also access to financing for SMEs, perception and reality. And it includes the definition of SME, review and summarize of the SME issues, additional insights from complaints, data and engagement with SMEs and outgoing initiatives. Let's continue with what is investment appraisal. It is the process of evaluating and analyzing potential investment opportunities to determine their financial viability and potential return on investment. It is also a way that a business will assess the attractiveness of possible investment or project based on the findings of several different capital budgeting and financing techniques. The purpose of investment appraisal is to assist individuals or organizations in making informed investment decisions by considering various factors such as the initial cost of the investment, expected cash flows, the time value of money, and the risk involved.
For Sweet Candy Berhad, we choose a mutual exclusive project that needed to replace the old equipment with new equipment. Therefore, the old machine will be disposed of and the tax implication will have to be accounted for by the disposal of the machine. Here is the calculation of the cash flow to determine whether they are relevant or otherwise. Firstly, we calculate the initial outlay by adding the cost of the machine, where the cost of the machine is 500,000 plus the installation cost of 50,000. Since the training cost is a sunk cost, we do not add it because it incurred in the previous month. Next, we need to add the working capital cost, which consists of the cost of increase in inventory and the tax loss to get the total cash outflow. The tax loss calculation is as working one. Then we minus the total cash outflow with cash inflow, which is sales proceeds of all machine to get the net initial outlay. Secondly, we calculate the differential cash flow over the project's life. For incremental benefit, the increase in sale of 300,000 minus the total increase in production and operating costs and the total increase in depreciation to get the total increase in profit. Next, we minus the tax of increase in profit to get the profit after tax. After that, we add back the depreciation to get the after-tax differential cash flow. The third part is to calculate the terminal cash flow by adding the salvage value of the new machine with the total additional inventory. In this slide, we will discuss the payback period, the net present value, the internal rate of return, and the profitability index for the new machine. First is the payback period, which measures how quickly the company can recover its initial outlay. To get the payback period, we need to divide the initial outlay with the annual cash flow. Based on this slide, the payback period of the new machine is 2.54 years or 2 years and 6 months. Second is to calculate the net present value of the machine. for year 0 and year 1 to 6 of the cash flow amount, we will get the amount from the annual differential after-tax cash flow. Moreover, the cash flow of year 6 is from the terminal cash flow amounting 50,000 ringgit. Then all of this amount will be multiplied with the PVIFA from the row of 11%. Thus, the total present value of the cash flow will be deducted with the total initial outlay to get the net present value amounting 321,043 ringgit and 49 cents. Third is to calculate the internal rate of return or IRR. We have chosen a discount rate of 33% to calculate the present value of the future cash flow and get negative 1,008 ringgit and 34 cents. After calculating the interpolation, we get 24.34% of IRR. Last is to compute the profitability index to measure the value that a project creates per ringgit of investment by dividing the present value of future cash flow with the initial investment. As for this new machine, we get a positive net present value project amounting 1.7255 of profitability index. As for the non-discounted cash flow method, our group chose the payback period methods, which measures how quickly the firm can recover its initial outlay. The earlier the payback, the better it is. As for Sweet Candy Berhad, the payback period for the new machine is 2.54 years or 2 years and 6 months. Meanwhile, for the discounted cash flow method, our group chose the net present value method, which is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. As for Sweet Candy Berhad, the net present value for the new machine is 321,043 ringgit and 49 cents. Therefore, by using the two selected decision-making techniques, we advise the Sweet Candy Berhad should replace the existing machine because the payback period is less than 4 years as the firm's maximum desired payback period. Other than that, the net present value shows a positive sign where it is higher than 0. This indicates that by replacing the old machine, the value of the company and hence shareholder wealth will increase by 321,043 ringgit and 49 cents.
For question 2, it is to measure the sensitivity analysis. Sensitivity analysis is an assessment of how responsive the project NPV is to changes in variables that are used to calculate that NPV. As calculated for ABC Campsite Berhad, the sensitivity margin of initial investment is 27.17%. For the variable cost of the project is 64.09%. For the sales of the project is 16.02%. Therefore, after we analyze the sensitivity margin of the variables, we have found out that the initial investment needs to be increased by 27.17% before the project NPV becomes 0, while for the variable cost need to be increased by 64.09% before the project NPV becomes 0, because further increase will result in negative NPV. For the sales, it needs to be decreased by 16.02% before the project NPV becomes 0, and further drops will lead in negative NPV.
For a small and medium-sized enterprise, the term SME is commonly used to categorize businesses based on their size, particularly in the terms of number of employees, annual revenue, and total assets. The classification of SME is very important because these businesses play a vital role in economic development, also in job creation in many countries. SME are considered the backbone of company as they contribute significantly to employment generation overall in economic vitality. Here, as you can see, a detailed definition of category from micro, small and medium as follows. But let's just focus on small and medium area. There are few main concerns of SMEs such as high cost of doing business, ringgit depreciation, reduce in demand and weak business sentiment. And due to these concerns, we will discuss issues rise for SME regarding to financing access. And now we will discuss issues faced by SME. Number 1, financing is a key constraint for Malaysia SMEs. According from the latest business annual survey by SMEs Corp, 97% of SMEs which applied financing were able to obtain financing. Of this, 27% were first-time borrowers, 22.6% were without collateral and credit. Less than 10% of SME will obtain financing first difficulty. This is due to delays in loan approval or disbursement. Also, requests for additional guarantors of collateral. And lastly, higher interest profit. Next, many perception from SMEs that applying for financing is an opaque and complicated process. SME commonly perceive that applying for financing to be difficult and time-consuming. But that is not necessarily true. In Malaysia, banks have streamlined and simplified the application process under the partner initiative that was introduced in 2010. SME applicants are provided with standardized loan application forms and checklists for their applications. Banks reported that processing time have been reduced to between 7 days for financing up to 50k and 16 days for financing above 500k. There are perception that banks do not extend financing for startups. From analysis data secrets in 2016 revealed that financial institutions continue to provide financing across the spectrum companies including startups. Startup companies are the company that in operation for 3 years or less. Lastly, some SME believe that in a downturn, SMEs are the first to experience withdrawal of financial lines or credits or reduced credit limits. From the SME Corp survey, less than 2% of SME with existing financial from institution cite difficulty as a result of reduced credit limits or withdrawal of credit liabilities by financial institutions.
Moving on, I will be presenting on additional insights from complaints data and engagement with SMEs, and also ongoing initiatives. Various issues were raised by SMEs to the bank for further investigation. Over the period, 6,423 complaints were received, which only 6.9% were from SMEs, and 8 cases were on loan rejections. Those complaints on difficulties associated with restructuring and rescheduling applications by SMEs. Majority cases were complaints by companies that either ceased business operations or were at an advanced legal stage. Initiatives being pursued by SME Corporation to support insolvent SMEs under statutory voluntary arrangement and provide fresh start for them will help solve this issue. Moving on to ongoing initiatives. Online SME financing application platforms. In collaboration with the bank, it would help further enhance the ease of accessing finance for SMEs. Alternative financing avenues required to complement banking system financing for SMEs. That will be all for this presentation. Thank you.